There we go. All right. So, hello everyone. Thank you for joining us. This is How to Raise Money in Silicon Valley and Beyond with Elizabeth Yin for Data 360 Labs, and we're so excited to have her here. For those of you who don't know what Data 360 Labs is, we're an online incubator that connects to accelerators like Elizabeth's and many, many others to raise funds. Globally. And so we have about 25 members that then have the opportunity to become partners with Data 360 and partners with Google and Amazon through the programs we're a part of, as well as develop their own ecosystems, customer bases, and partnerships. If you have any questions about joining Data 360 Labs, please feel free to email support at data360.solutions. And with that, I will leave it and send it over to Elizabeth.
Thanks, Marie, and thanks for having me. So I think we'll just kind of dive into it a bit. I have a short presentation, so let me share my screen here. Can you guys see my screen?
Yes.
Okay. So yeah, so I have a brief presentation. Like literally, there are 7 slides here, and then since I can't actually see the Google Hangouts tab anymore, I think we'll just take questions at the end. So and then basically most of the time will be used towards questions. So essentially, I have just a basic outline on the tips that I have found to be the most effective in raising a seed round in the Valley. And I've already talked a bit about my background, been an entrepreneur and now an investor. And I think one of the very first things to understand about raising money is where you fit into the landscape. I think this is particularly challenging for entrepreneurs, not just new entrepreneurs, but serial entrepreneurs, because this landscape is always changing. So what the way the landscape is right now today, and it may change again in another year or two, but the way it is today, at least in the Silicon Valley, is that there are 3 stages of seed. There's pre-seed, seed, and post-seed. In contrast, if you have ever raised money for a startup, or if you had a startup like 5 years ago, what was common then was there was a seed round and then a Series A, but that is no longer the case. And it's really just a nomenclature game. There's nothing particularly different about 5 years ago and to today, but in terms of what things are called, it is different. So in these 3 stages of seed, pre-seed, seed, and post-seed, essentially what I've outlined here is what people are looking for at each of these stages. So in pre-seed, typically you don't have very much. It could be a product or a very basic product, and you have pretty much negligible traction. And these raises tend to be smaller. Certainly sub $500,000 is very common. They're mostly done by friends and family, other angels as well. And now there are some pre-seed funds that have come about. Hustle Fund certainly is one of them, but we have other peers as well. Precursor, Unshackled, A4 to a certain extent, Notation Capital in New York. These are all examples of pre-seed funds. And then, traction, we're not really looking for any particular numbers to hit here. This is very much about belief. And, we are wrong all the time because our beliefs are not necessarily right about whether we think this will be a big opportunity or not. But that's what this stage is all about. The next 2 stages do generally require traction. I'd say that on the far end, the post-seed stage actually is basically the old Series A. So in the old days, like a few years ago, people would often tout like this magical, if I hit $1 million run rate number, you'd be ready to raise a Series A. That's no longer the case anymore. And what has basically replaced that is the post-seed. If you get to $1 million run rate, you can largely raise a post-seed round. And the valuations at this post-seed round are what the Series A used to be. So it really is the old Series A. What I think is notable about all these stages, though, is if you have Sandhill Series A firms, they still are doing Series A deals. But what I'm saying is the Series A is happening later these days. In other words, if you were at the $1 million run rate before, you might start going to Sandhill. But these days, it's a whole new group of people who are doing the funding for that stage. And in part, this is largely driven by just firms' ability to raise. Like you've seen some of these big Sandhill funds get in the news for raising like $1 billion funds. $1 billion funds, like those are super huge. Like 10 years ago, a super huge fund would be, 300 million. And so what you're basically seeing is, well, if you're a $1 billion fund, they no longer are really interested in playing around with 500K or $1 million because that's just a lot of time to be spending on such a small check relative to their fund size. So that's really what's happening here. And then seed is sort of in between, as you can see. So that's the first thing to understand. Like, so if you were running a startup a few years ago and you thought, oh, I should pitch a Series A fund at these traction points, that is no longer the case, I suppose, is the takeaway. The second thing is, all right, once you kind of figure out where you fit into the landscape with regard to your startup, then I think a common strategy that I don't see founders employ enough, but I have found to be particularly useful, is to create multiple fundraising plans. So the first thing that you want to figure out is, what are kind of the different scenarios that can happen? So you really want to be able to articulate a case for, what are you raising for? Is it for growth? Or is it for development? Or is it some combination in between? Like, the ideal scenario is investors basically want to put in money and you immediately make money. They don't really want to put in money for you to go and hire a lot of engineers and then not have anything to show. So it's really important to kind of think in these terms. If you put 500K into your business, what is it that you expect to achieve by, let's say, in the next year or so? And very often I hear founders say, oh, I'm raising, $500,000 or $1 million for 2 years of runway. Like, that is not a story that investors want to hear. They want to hear, I'm raising like $500,000 or $1 million to get to this traction level within the next year, or something along those lines. I would also add some buffer around these estimates, since they're going to be wildly off. And so when you go and then create these multiple fundraising plans, they're going to be based on data that you already have. And this is going to be not that much data. So if you're testing Facebook ads, like maybe you're testing $10 here and there or whatever, it's going to be small numbers, but it's a place where you can start. And you're going to be wildly wrong in your projections, but it's a good starting point. So based on, we've been doing Facebook ads and they seem to convert like this, and we seem to have a 2-month payback period, then I think I can get to here at this stage with this amount of money within a year. I'd say in general, the caveat is that, projections are useless. So if investors are asking you for 5-year projections, I would actually, just frankly speaking, push back and say, as you know, these 5-year projections are going to be completely inaccurate. But I do think it is reasonable to create like a 1-year projection, because 1 year you kind of have at least a grasp of the costs, and then potentially some estimates around the revenue. And this,
Hey, Elizabeth, I want to ask you one quick question.
Yeah.
About the deal mechanics of how to get to 1-year projections. You want to speak a little bit, because I know you do that with Hustle Fund. Just a quick quip about how you kind of get to that, like, the technology, I know you guys talk a little bit about how you do that.
Oh, about you mean how to get to the deal?
Yeah, kind of how to get to the mechanics of the business. So you talk about, I noticed on your site, you talk about, here's MailChimp, here's Facebook ads, here's this, here's that. You want to talk a little bit about, just really quick, about how you set up the mechanics to get to the 1-year projections?
Oh, I see. Yeah.
How do you advise startups to do that, I should say?
Yeah. So before I answer that question, I think a common thing that I often hear from founders is, oh, we have spent no money on customer acquisition. And people seem to tout that as a good thing. This is actually not a good thing in the eyes of investors, because if things are completely free, one, it's actually not entirely true. Like, things always cost money in some form or another, even if it's not ads. And we'll talk about that in a second. But the second thing is, it also means that you haven't really tested how you can get to scale. Like, just waiting for people to, come to your product is not going to get to scale, for the most part. Not in all cases, but for most businesses. So then the question is, like, okay, well, how do you kind of get some unit economics around this plan? Like, how do you know how much things will cost, and how do you know how much revenue you'll be able to make? So on the cost side, at this point, you're probably not pouring a whole lot into paid acquisition, but you are testing different channels. Like, maybe you've cold emailed a bunch of people. Maybe you've taken out a small ad campaign with the free ad budget that Google and Facebook give you. Maybe you have, tried some sort of partnership with another company. Maybe you've tried a number of these things. I think the more that you test, the better, even if it's at a small scale. And then really track, like, how much did that cost? Certainly for the ads, That's easy to do. You know how much you paid, even without the free credit, how much would you have paid, and then how many people ended up converting, and how much revenue does that generate for you. So that gives you a sense of the costs and the revenue. But even for the non-ad channels, you can do the same. Like if you are cold emailing people, if you had to pay somebody to do that, how much would you pay them? Like, could you hire an operations person at, I don't know, $20 an hour, $30 an hour? Maybe if you're outsourcing to another country, maybe it's cheaper, whatever it is. And then what is the response rate and what does that kind of convert into? So there's always a cost, even if it's not ads. Like if it's outbound sales, like through cold emailing or cold calling, there's a cost. Because if you were to scale that up and hire all these people, like there would be a cost for that. If it's partnerships, there's a cost. If you had to hire somebody to basically do partnerships with companies all day, every day, what would that look like? How many partnerships could somebody potentially do? And what is sort of the yield on those partnerships? So that's how I would think about this. And then working backwards, obviously these are small numbers, but you can start to get a sense of, okay, if I were to hire one other person to do exactly what I did, like full time, let's just say hypothetically, how much do I think I could do in sales from these different channels for what that person was hired to do? So that's how I get to that 1 year projections. And then I think, and then my final thought on this is like, you want to create a couple different plans. So like if I raise $500,000, what do I think I could get to? Does that differ if it were only 250,000 or $1 million, whatever it is? And then the last point here is, okay, now you kind of got your plan and your messaging, like this is what can lead to growth. These are the costs and the revenues on that. Now, how are you going to actually go and meet investors and close this deal? So the last thing is, it's really important to create urgency. So I guess if we take a step back and think about the investor's shoes, even if an investor is really fast and is a nice person and doesn't want to screw you over and, honestly wants to do your deal, when you think about it, investors have zero incentive to invest today for the most part. Because if you were really interested in doing a deal, it is much better for you to wait and get more information on that deal and get in at the same valuation 6 months from now if you can. And you would just keep on waiting. The only reason you would do that deal is if that deal all of a sudden were off the table. Like if 6 months from now that deal were not available, then that would force you to move and decide whether you want to do the deal today. And so thinking about it from that lens, then it means that you have to create urgency. Like you have to ensure that that deal will not be around in 6 months or in 6 weeks or whatever it is. And so that means that you basically have to create FOMO. And the way to do that is essentially to have lots and lots of investor meetings so that way you can create urgency. And so the way to do this is, at least at the seed level, whether it's pre-seed, seed, or post-seed, you want to first make a list of all the investors who could be relevant to your deal. And this actually takes a long time to do research on. Like, I don't actually think there's a really easy way. I know that, there's AngelList and Crunchbase and all these other sources, and FRB has posted like a spreadsheet of hundreds of investors. There are all these lists, but at the end of the day, you still have to do a little bit of research around what these investors do. Like some investors only invest in B2B businesses, other investors only invest in certain geographies, others only invest in certain demographics, others, of course, only invest in certain stages. So you need to kind of do a bit of homework around like who is the relevant list for you. And then you need to somehow get to these investors. So I think my recommendation here would be try to get warm introductions if you can. This can be incredibly time consuming, but in parallel, I think more and more investors these days are open to and are actually answering emails that are coming in cold if it's a well-crafted email. So I would say our own stats for Hustle Fund, roughly 20% of our portfolio has come from cold, like where people literally applied on our website and then we did the deal. But the vast majority, as you can see, still came from warm introductions, and they came from warm introductions of all kinds of people, other founders, investors, advisors, just people in the startup community. So warm introductions still are better, but I would do both since sometimes warm introductions take a while. And then after that, you want to line up your meetings so that they're really packed in on your calendar, because that's the only way you're going to create FOMO. So since investors tend to be pretty busy and have their calendar packed already, like I would actually start this process a few weeks in advance so that you can get on people's calendars 3 or 4 weeks from now. And then you can really pack them in. Like an ideal scenario is maybe you're doing like literally 20 meetings a week. And then finally, the way to close is essentially to paint the picture that you are doing so many investor meetings and that this is moving along so well that you're not sure if this opportunity will be gone in the near future. Now, of course, you can't make any promises that you're going to close in 6 weeks. You're going to close your round in 6 weeks because you just don't know. But what you can say is, well, I don't know when I'm going to be closing my round, but I have 2 second meetings next week, and I'm going to do another, 5 first meetings in that same week, and it seems like there's a fair bit of interest. And then investors kind of have to decide, well, how interested are they in moving along with your pace? And that's really the way to close. I think if you're just sort of doing one-off meetings here and there, it's very difficult because, again, investors would much rather wait. If they know that this deal is still going to be around in a few weeks, they would much rather continue to wait for your updates and hear more information before deciding to invest. So I think with that, that's sort of the basic process that I would outline. I've hopped out of that presentation and would just love to open it up to any of your thoughts and questions.
Well, Elizabeth, I have a couple to kind of start it off.
Sure.
One is traction is always such a mystery. It's a mystery. I say traction and modeling are mysteries. And I know for me as a sort of science nerd, that was like an elusive thing for so long. And I started my career raising money. But I started my career raising money on a unicorn, which was terrible. So it was very easy to raise. It was a lot easier, I think, than normal to raise money. It was not easy raising money, but it was easier.
Yeah.
I think traction is kind of this elusive detail for people. I kind of mentor a lot of businesses and entrepreneurs around that. So you want to speak to kind of how you encourage your entrepreneurs? I know it's like you said, you funded like 40 plus businesses initially for pre-seed, and then but only 7 of them got a follow-on check. Explain the difference between the 41 and the 7.
Yeah, so a couple thoughts there. Can talk about traction. So for us at Hustle Fund, we are investing in 100 companies on this fund. Actually, we have invested in 62 at this point. We tend to invest in 1 company per month per partner. So 3 deals a month, all software, but within software, fairly vague, I guess, fintech, B2B marketplaces, generalists. And then we will occasionally write a follow-on check. So our first check is $25K, but occasionally we'll write a $250K check. So for the very first check, we are not looking for traction. For that second check, like traction is definitely a very important criteria. And we have done 9 follow-on checks for that second check at this point. And basically, if I had to like categorize the 9, like we don't treat them any different from our portfolio, but the reason we poured more money in is that they are doing well. I think almost all of them are above the $1 million run rate number at this point. And so I think all to say is that, so that's a bit about us, but then that kind of ties in nicely with traction, which is, I think you're absolutely right, Marie. Like, I think traction is unfortunately a very frustrating topic because no one really knows, like, what is that bar? And the bar always seems to be moving higher and higher. Like, you go to an investor and you think that you've met what they're looking for, you come back and they're like, actually, it's not good enough. And so I'll tell you, like, what's really going on there, because it seems like some people have it easier and other people don't. And there are a few things that are going on. So one is storytelling. I think in all stages of the seed stage, pre-seed, seed, and post-seed, storytelling is still number one. Like, even if you have traction, like we have some founders who are very bad at pitching, but they are phenomenal executors, but they still struggle because the storytelling is not compelling. And storytelling is a number of things. One is just charisma storytelling, and that's one thing, and that's practice, and some people are better at it than others. But then the other that is very much within your control is like crafting a story around differentiation. And I think that is probably the number one reason why that bar is so different. Like if you are the only one doing X, the kinds of questions that you need to basically answer is like, why is this a big business? Why is no one else doing this? But if you're in a competitive landscape, I'd say it's actually much harder. The questions are like, why can't Salesforce squash you? Why can't Marketo squash you? Why can't all these companies squash you? And I feel like if you're in a very competitive landscape, it almost doesn't matter what traction you have. Like it's going to be really, really hard. So traction, it's very nebulous because it really depends on your particular idea. Is what I would say about that. And I don't have any clear answers around what those numbers are. I think if we go back real quick, though, I would say that being within the bands of where the investors you're pitching are like is actually pretty helpful. Then it's a matter of just like meeting enough people to figure out like who thinks your product is differentiated enough and whatnot. Like if we go back to this slide, you can see the run rate differences are huge.
Yeah, super huge. And then the other question I have, and then I'll let everyone else talk, is the homework in principle the same for investors and customers, more or less, where you have to kind of notice their preferences? I was speaking to an MBA class at USC 2 days ago, and they were talking about tech commercialization, and one of the things they didn't understand was that they had to really specialize in understanding people and the way that people want to transact. And investors want to transact certain ways, and there's a certain category or nomenclature. There's all kinds of words and things that they use that you have to learn. And then your customers and all the different segments of your customers also have the same thing. How do you get people used to that way of thinking?
That's a good question. So I'd say that they are different, but both are sales jobs. So for in the way that they're similar, I agree with you. Like it's a sales job, it's trying to understand what makes somebody tick. So actually related to your last question around traction, like even if you're in a competitive space, like VCs may not touch it because they've seen 20 other businesses like yours last week, but you may go to angels who don't see as much deal flow, and your traction will be impressive to them, and you will seem differentiated to them because they haven't seen other businesses like that. So it's sort of a matter of like finding the right investor fit. There are other investors yet who are looking to invest in certain verticals, either because they own a business in that space and want to look at new technologies such as family offices and corporates, or they want to really learn about a new technology, maybe like blockchain or something like that. And so the reasons people invest are all very different. VCs, it's pretty much to make money and to make the biggest amount of money they can. Angels, that's definitely not the case. Like sometimes people who are angels invest just because they like you or because they really love your product, even if it doesn't make money. So I think it's a matter of like finding that particular type of person, what he or she likes and wants, and crafting your story towards that. And we certainly had to do that in fundraising as a fund. Like funds are not differentiated at all. Like if I think product companies have a hard time with this, funds haven't even heard of it. So, I mean, it's a matter of crafting that story. So that, and then going to the other point that you made about sales. So the way though that I see things different between customers and investors is, customers, you just have to convince that one person and whatever story it is for that one person. But the problem with VCs is they all, like I said, need to kind of be FOMO together such that they believe you can bring a round together. And so there are dependencies with other investors, and that's why I think the game is often weird or terrible or just not intuitive versus a customer. It's like, I just gotta make that one sale.
Yeah, I think that makes sense. And one quick follow-on question: what about all the investing and things that are happening with like the Googles and the Amazons and the Salesforces and the Microsofts in grad students in small businesses? We've noticed this like huge shift, and we've benefited a lot from Google and Amazon's investment in our company, investments. Where do they fit in the mix of all of this? Because this seems to be a little it's been expanding a lot recently, and it seems to be newer. Joint ventures are not new, but it seems to be really targeted
Yeah,
towards
the
startups.
corporates are an interesting category. 5 years ago, I'd say corporates were probably a bad category to go after. But these days, corporates are really getting very aggressive in working with startups. And this can be a good or bad thing depending on the corporate. Some corporates are faster moving than others. And other corporates are just really slow moving. But I think it's a matter of like assessing immediately, like in that first meeting or that first interaction, like what kind of, like whether they'll be a fast mover or slow mover or whether they'll be a pain in the butt to work with. But we are seeing a lot of that, like just because I think a lot of corporates and family offices who run businesses feel like I really need to keep my eye on the pulse of technology to make sure I don't get left behind, because that very much is what is kind of happening now. And so I think, that actually is another group of people where maybe ROI doesn't matter for them. Maybe what they're interested in is just seeing new technologies or ideas. And so raising money from them is like a totally different story from raising from VCs. Obviously, people don't want to lose money, but like the amount of money they are looking to make may vary quite a bit.
Yeah, it may not be as much about explosive growth as it is with a VC.
Yeah.
Yeah, absolutely. Okay, so let me open up the floor to whoever else wants to ask some questions. Feel free to unmute yourself, or I might call on you. Anyone else? All right, I'm going to start calling on people.
Oh gosh, I always.
Okay, go ahead.
Hi. So my name is Elissa Kuykendall-Unton, and Maria, I found you through the Female Founders Facebook.
Hi, nice to meet you.
Hi. And I know one name on the list. I won't out you, but my startup is called Arcvita. I'm a CEO and co-founder, and we're incorporated, and we've pivoted twice, and now we have some revenue, and we've got a freemium model that's converting really well, and we raise money. So I'm in founder gym right now, cohort 5, and I'm gonna start probably late February, early March. So that's kind of who we are, what we're doing. Specifically, what Arcvita is doing is changing the way people work. So either how you get hired or how companies form teams. And our first service is just one piece of that, and eventually we'll expand out. So my question to you, and thank you, by the way, I love how I compliment to you on your presentation being about demystifying, because I love the efficiency of that. So thank you. I love the efficiency. So my question to you is around pacing and cold emailing and meetings. So I think, like, I have a great finance network, but it's the wrong network for fundraising. So I think like 10% of the people that we'll go meet with are people that are going to come in through my network. And then like everybody else is like, hey, Elizabeth, don't you know anybody? So like, can you give us a little bit more insight into either crafting an email or like thinking about the schedule from, and I recognize that you're the investor, not the entrepreneur, but you've coached a lot of us. So if you could think of either tell us more about crafting the email or framework about reaching out.
Yeah, certainly. That's a good question. So actually, maybe after this call later, I can send a couple of links to resources that might be helpful. But I think in a nutshell, the cold emails that have been really effective with us and also tend to look very similar to what I've seen on the web that have been effective with other investors is basically something very concise, like a couple lines about what you do and maybe like call it 3 bullet points around something that is notable about your company. So if you have marquee pilots or customers, if it is traction, maybe it's not. Maybe it's something about your team that's unique. I don't know. Well, whatever it is, and it's a matter of kind of playing around with what is unique for those 3 bullets. Maybe it's about a particular learning or insight. Maybe it's your domain expertise. Maybe this business came out of something that you were working on before. Whatever it is, like essentially at a high level, a couple of sentences about what it is, those 3 points, and then a call to action on, like what is the best way to talk about this or something like that. And that's what I would send. I think bonus points would be if you spend the time to research the investor and know what kinds of things they like, then you can maybe throw in a sentence of like, I really would love to chat with you per your experience with ABC company or DEF background or whatever business they used to run or whatever it is. That of course like is always nice. Like BC's like our vein, and so they like that. But it also takes time, so I can fully understand how you may not have the time to do that, and I don't think it's necessary to get attention either. As far as reaching out to people you don't know, like doing it cold, so like where do you get their email addresses? I mean, I think like various people have tried to build lists. I think if you could just kind of search around, or maybe even in the female founders group, like if you even ask that, I'll bet somebody has built a list and would not mind sharing.
Great, thank you. And yeah, definitely do share that template. A link later is awesome.
Yep.
Yeah, and we do, by the way, some of that list building stuff, but in a we don't just give you a list, but we help you build out your campaign. So if you're building out an investor campaign, that's part of Data 360 Labs. You can do sales, investment, you can do fundraising, all kinds of stuff, but investment is one of them. So we can definitely help you build out some of that in a very smart way with a bunch of data around it. Okay, who else has a question? Don't be shy. Let's see. Maria, do you have a question?
You're going to ask for me.
You know I was going to get you.
How are you?
Hello.
Thank you very much. Marie, thank you for pulling this together. This is awesome. By the way, I've been on a lot of these, and I have to say, you are one of the most articulate presenters I have heard about staging and where we should be as companies when we're going out for certain amounts of money. So my question is actually going to be around that, because we're a little odd. And I preface this with, I am considered an expert in my industry. This is not my first startup. I actually have exited 2 times before, but I am coming from that time when an A round was 2 million. So yeah. I remember all of that, and I raised in Boston, very different environments. So yeah. We've got a working product. We've got notable clients. We've done a proof of concept with eBay. I think all of the things check with traction. Because of the model that we have for our business, we've actually done it in a slow growth. And this is literally based on our advisors, one of whom comes from Amazon, who ran the beauty and personal care division for them. So we tested out, so we have a willingness to pay because we tested out. We were at 2,500 MRR, and then we stopped that. We made a very sound decision that we're going to onboard all of, because we're a 2-sided marketplace, sorry. And I believe we've got everything checked except for the money part. We don't have revenue. So do we still go after the low amount? Because all I did was raise a very small amount with friends and family and bootstrap the rest of it. We're at that point, we launched our MVP. So, and I probably should tell you what we are. We are, you caught me off guard, Marie.
It's okay.
Anxiety and guesswork out of finding a hairstylist you love. We actually use epigenetic data and data from thousands of different successful relationships to develop what we call our matching algorithm. And we screen and vet all of our hairstylists and barbers. So it's a 2-sided marketplace, and we've got testimonies and all of that good stuff. So I'm going to stop there. But we do have traction, check, except for the money part.
Yeah, and I would say that what I've outlined, I tried to make it as cookie cutter and broad as possible, but obviously there are always like different scenarios, right? Like for example, an enterprise company very much doesn't really fit what I've outlined here. I'm just kind of resharing that slide. An enterprise customer may have pilots, right? But the pilots may not be yielding the big money, but they still may be able to raise in, let's say, call it the seed category or whatever. So there are always kind of exceptions, I suppose, is the point. Regarding your particular scenario, though, I think my question to you is, like, you have done pilots. Are these paid pilots? What kind of happened after those pilots? Like, are they continuing to work with you? What does that look like?
Yeah, we were actually testing this out if this would be a good offer for wellness to roll this out in a corporate structure.
Mm-hmm.
So it was actually a pilot for 3 separate meetings up in the Bay Area. One of which was with eBay, another was just separate by doing direct to consumer, and then another was with Salesforce. And we used Salesforce's access to their employees, and then eBay, same situation, where they attended because of a certain topic. So think, and go ahead.
Oh, and so are they continuing to, the pilot was a workshop, or are they continuing to work with you, or what does that look like?
They will so they were waiting on the technology. Technology is ready now. So we wanted to make sure that some of the things that we were asking, without giving too much, but as I started to say, we're epigenetic data is incorporated into our, what we call our beauty quiz. So we wanted to make sure that, number one, what we're asking is the right attributes, and how could we then deploy this within that kind of an environment to drive impact.
And you were not making money because you didn't charge for the pilots, or you didn't charge their user or their employees?
No, I did charge for the pilots.
Oh, you did?
Yeah. Yep.
Okay. I mean, I think that if you have marquee pilots, that certainly makes up for revenue. I guess my general advice, since I don't know the particulars of your situation, but my general advice here, kind of going back to this slide really quickly, is that I would actually try different segments. So, for example, in there's pre-seed, seed, and post-seed. I would probably try to hit up investors in pre-seed and seed at least, and gauge kind of response. So like if seed is like, well, you're too early, like if you hear that from a few different people, then you're probably too early in people's minds. Like if you're only hearing that from one person and everyone else seems to, be interested, and of course that's a subjective decision, then that may just be that one person. But if you tend to hear the same thing over and over again, I would really take that to heart, whether it's your business or anybody else's in this room. And then I think, this is also why I say you may want to have a couple of different fundraising plans. Like if you could raise $500,000, what does that look like? What are you trying to achieve with $500,000 versus if you were to raise $1 million or $2 million? What do you think you could achieve with that? So I would paint out a couple different scenarios, and then when you go into these meetings with folks, like let's say that you're going to, one of the larger seed funds, like Felicia's has 3, it's like $1 billion fund, and I think Floodgate as well. Like if you go there and I would paint the larger plan for them. But if you go and meet with like a smaller fund, like one of the micro funds, I would probably paint the smaller plan. And if anybody says, oh, well, this feels like too big of a round or too small of a round or whatever, you can say, well, actually, I have a couple of different plans. Like, I've mapped out a couple of different scenarios. And, if you're pitching the smaller plan and people say, oh, you should be raising more, you can say, actually, I have this larger plan. Certainly if people are interested in doing a bigger participation, like this is what we would do with this larger plan. But, even if we don't raise this larger amount, we can still achieve X with the smaller plan. So it shows that you're prepared and have thought through different scenarios.
Okay. Thank you. Great advice. Appreciate it.
Because I just hate it when people are like, you go to an angel and they say, oh, you're raising too much, like I'm a small angel. Or you go to a larger fund, they're like, oh, you're raising too little. Like it becomes sort of a Goldilocks and the 3 bears problem.
Yep.
On top of that.
Absolutely. So I know Eric has a very unique model. Eric, you want to talk a little bit about your traction and where you are right now? I know you have a bunch of meetings and deals on the table. He's one of our startups. Eric, are you there? Can you talk? Are you in a
Yes.
cafe?
Can you?
Okay. Yeah. Now we can hear you.
Yeah. So yeah, it's interesting. So what basically our business is a laboratory for XR. Uh, so we're looking to be the best possible support for people who want to create great VR and AR experiences.
Mm-hmm.
And so we're coming at it from a couple of different angles. We're looking to launch the pilot this year at Loyola Marymount University, which is located, the new campus is right in the middle of Silicon Beach. And we're, having conversations with Facebook, Oculus, um, Amazon, Sony, about being sponsors. We would like to.
I think you dropped off.
Yeah, I think he did drop off. Let's see if he'll be back on in a minute. Erica, do you have anything you want to ask or talk about? Erica is a dynamic lady who I missed on a phone call. We got to circle back.
Yes, we do. Hi, Marie. It was good
Hi.
to see you. Thanks again. And hi, Elizabeth. It's nice to meet you.
Nice to meet
My
you.
name is Erica. I'm a founder of a hardware startup. It's called Water Can't Wait. And we were founded in response to the crisis in Flint and other water quality issues that are happening all over the country and globally. And so we are creating an IoT smart water filter for the home. The idea is essentially to bring the kitchen faucet online and use all of the capabilities of hardware and software to make our drinking water safer than it is today. So that's the idea. I'm still very early stage. I've just recently built my tech product team that will work on the prototype. So I have a data engineer who's the CTO. We're working with 2 faculty members at UCLA in the engineering school and the School of Public Health. And then there's some other groups of advisors in various disciplines coming together. And so I'm in a bit of a tough spot in that there's no prototype, but there is a great team who can deliver on the prototype. And people are telling me, well, you can't raise money until you have the IP. And my situation is, well, I have to. There's no choice. There's a budget, there's a timeline, there's a process we've identified, and it's going to cost some money. So I was curious to know, in this pre-seed stage, what are the examples of key milestones that investors would expect to see as I'm presenting my pitch to them?
Yeah. So I think first off, what you probably have already heard from other people is the hardware is rough. That's because there are not a lot of investors who want to take risk in hardware. So I'll just get that out of the way up front. But I'm sure you already heard that. It's not to say it can't be done. It just means that you need to get creative, right? Like the normal VC routes. I don't know how much you've tried. It may be worth a try, but I think it's going to be rough. A lot of people do not invest very early at this quote pre-seed stage with hardware. It's even just hard even once you have traction for hardware in general, because frankly speaking, there are a number of investors who got burned by past hardware companies who didn't know what they were doing at the manufacturing stage. So even if you have something really awesome, you have a whole bunch of people in Silicon Valley who know nothing about manufacturing, trying to invest in other people who have not in the past and have just burned a lot of money and could not get product out to the market, let alone market traction. So that's kind of the context. So I think this is where you're going to have to get creative on a few fronts. So I guess one is, I don't know whether you're thinking about selling direct to consumer or whether you're thinking about going B2B. What is that? How are you?
Direct to consumer.
So if you're going direct to consumer, I mean, I think for what I've seen for hardware is like Kickstarter is probably one option. I know you know that, but I would say like of everything, like that is probably the most reliable thing that you can count on for yourself, right? Because that's you doing an effective Kickstarter campaign as opposed to trying to hit the pavement and relying on other people. I think the other that's unusual though that a lot of people are not doing is, you know, like I just got back from Asia, and you know, like for example, in Taiwan, like there's a lot of manufacturing, and a lot of that manufacturing actually has gone overseas, like overseas from Taiwan. So like it's gone to China, other parts of Southeast Asia, and so people are looking for innovation in hardware, for example, in Taiwan. And so this is going to be a matter of like, can you then network into that? Maybe it's worth a visit there. There's a program called Garage Plus, which is a completely free program for entrepreneurs. I mean, you have to get accepted, and it's not an accelerator, but it's like a 1 week sort of networking program where, you know, if you get accepted, they pay for your flight to Taiwan, they pay for your accommodations and everything. And then you go and you meet all these manufacturers and corporates who are interested in looking at new technologies, and they do invest. So, and then you may be able to get a partnership, like a manufacturing partnership as well. So you're going to have to kind of go outside the usual circle. There are also family offices that are very interested in looking at new technologies who aren't kind of in manufacturing or you know, utility types of industries, but they are not like well known. They don't have a website. So then you're going to have to like search and find people. And I don't have a great answer for how you do that. I mean, I think speaking, actually, that's pretty akin to our fundraise for our fund. Like there are funds of funds, like there are institutions who invest in funds, but they mostly invest in the usual suspects of people who have a proven brand, like all the Sandhill funds. So as a new fund, like where do you go? Like those people are not interested in people like me. So then you have to get creative and start like finding other pockets of money. And that is just, you know, going to take some time and is work, but it can be done.
Okay. Thank you so much.
I have something to add into that, which is Arrow is partnered with Indiegogo to do manufacturing projects, and they write somewhere around they do build your prototype for you in some kind of way, and they also fund, I believe, up to $250,000, 250. Okay, and then if there is any mobile component, then AT&T is partnered with them to do some mobile component stuff as well.
Cool. Thank you. Thanks so much.
Yeah. So yeah, you're welcome. Going back to Eric.
Hey, sorry about that. I lost you guys. So I don't know where we had.
So you said Oculus and Sony, and you mentioned all the big wigs.
Yeah. So
Eric's a Hollywood guy, by the way. Go ahead, Eric.
Yeah, we're looking to build these partnerships, and really looking to create a specialized workspace, particularly around VR and AR and training and support. So again, also we're looking to really create kind of like best practices. So be like a free resource for white papers, for information, videos, like whatever type of media we can employ to get those kind of tips and tricks for the best production methods.
Sorry, so I missed the initial premise. So you are looking to raise money to build out this space, or didn't quite catch it.
Well, yeah, I guess we're looking to. I mean, I'm trying to figure out actually where we are. Like if we really should be raising money at this point, being like housed in the university. And should we be more like looking for grants or donations? Do we have enough of a business model that's really sustainable or interesting enough to an investor at this point?
What is the business model?
Again, it's like basically a WeWork, so it's a co-working space for VR and AR, but it's also like training and development that's specialized to your team. So you come in with a project. We provide all the hardware. We can give you production. We can match talent and services for you. Basically, everything that you need to produce a prototype, we'll provide for you.
Got it. So my general thought, and I know we only have a couple minutes, is so I think just in general, whether it's for your business or anybody else's, like if you are able to make a lot of revenue without needing external investors, like that's what I personally would do all day, every day. So I don't know if you're able to sell your educational components in this free space and make that work, but I would milk that as long as you can if you can. Now, if you are not able to, and you need the money to either build a space or the education component is not selling as much, or you have restrictions because it's a university space, whatever it is, then actually, I think also for you, kind of like Erica, I would imagine that your investors would be probably different. Like a lot of the VCs are interested in investing in like a software product. That being said, there are both ton of like real estate investors out there. And I think actually people would be very interested in this because real estate investors are looking to figure out how they can get on this tech bandwagon, and people missed out on WeWork. So you can basically sell this as like, well, this is the next WeWork and there's tech, and you can kind of also learn about it. I think that's another selling factor, especially if you're approaching like real estate family offices and stuff. But again, kind of like with Erica's situation, I think that might require a little bit more research. For example, like Fifth Wall in LA, where you are, is a real estate fund. The money comes from 5 top real estate companies. They're looking to invest in real estate, quote, tech things. And so I think it's just a different audience of people you would be pitching. Those are kind of my thoughts on that. I'm not sure if that's helpful or answers your question.
Yeah, no, that's great. That's actually a different kind of line of thinking that I hadn't really considered. So that's really helpful. Thank you so much.
I guess one other thought is like, maybe yours could also work as a Kickstarter campaign as well. Like, given that there are a lot of techies who are on there, like if it's framed as, an educational space for learning and developing businesses around, VR and AR, I actually think that audience might be very strong for you as well.
Awesome. That's great. Thank you.
Sure.
Awesome. All right. So we're at the top of the hour. Anything you want to say to wrap it up, Elizabeth?
No, thanks for having me. It was great to chat with you guys. I think I'm very open about, well, both what I think as well as with my email address. So if you have other questions that come to mind or that we didn't get a chance to talk about because of time, it's actually, maybe I'll just type it in the chat right here. It's Elizabeth at hustleonvc.com. And so you can feel free to email me at any time. I'm actually pretty responsive to email. So it was great to chat with you guys. Thank you.
Awesome. Well, thank you so much for joining us. And we are so excited to hear you talk about different models. I think it's so rare. I really appreciate you because it's so rare to kind of get that insider look into the VC universe and the investor universe. It's becoming more common, but it's still very, very rare. So thank you so much. And we look forward to connecting with you after this.
Yep. Thank you.
All right. Thanks, everyone. Have a great day.
You too. Bye.
Bye-bye.